Hello guys. Hello. So today I'm going to be showing you guys how to spot reliable entry patterns. So typically, before a buying market reverses, it gives patterns that suggests it wants to sell when it's not yet ready to sell. For example, on the average, a market gives 3 reversal patterns before it eventually reverses. However, in as much as those reversal patterns may look the same, but when you pay close attention to them, there are usually differences between those patterns. So there are things or conditions you see in a pattern, and you can tell that that pattern is likely, that reversal is likely to hold. This is in addition to other parameters you use to frame your idea, to frame your trade. Normally, entries are done on lower time frames. For example, if one is using H1 to frame the direction of your trade, M5 or M15 could be used for entry or entry patterns. So today I'm going to be showing you how to spot reliable or no reliable entry patterns on the M5, which is usually the time frame I use for reversals. So let's start with this one. The first thing you look out for is the formation of a pattern. That is an M for a sell, an M formation. Sometimes it could be head and shoulder formation. So when you see a head and shoulder, you could simply amputate the left shoulder, and that leaves you with an M still. But not all M's is an M or is reliable. So the ones that are more reliable than others is what I'm going to show you, the conditions, parameters you see that will make you tell. Number one is that there should be a break of neckline. For example, here, this is the neckline here. Here is the neckline. So this is the candle that broke neckline, the neckline. So when this M is formed with this candle here, breaking this here, this line here, neckline here, then you know that entry pattern, it's a good one. However, like I said, no one should go just entering on entry patterns. Entry patterns are supposed to be used in conjunction with other parameters that you use to frame your trade. It has to be, you should be looking at the entry pattern in a particular zone, the zone, your anticipated zone of reversal or retracement. That's where these entry patterns are you're supposed to be looking at them. So even at your anticipated reversal zone, sometimes it could give you fake reversal patterns. If you enter, it will go up. Again, in the case of a sell, hit your stop loss, give you a fake one again, hit your stop loss, and then reverses, or sometimes keep going up. So there should be a break of neckline here, like for example here. And for this pattern, which is a sell pattern and M, the candle that breaks the neckline must close bearish. It must have to close bearish. So when it closes, like here, this candle, once it gives a break of neckline, closes bearish, then you can sell, you can enter. So let's look at this. So this is the neckline here. This is the neckline, that little green or rectangular area is the neckline. And this is the candle that broke that neckline, this candle. So sometimes the candle, or by the time it breaks the neckline, it may be, if you enter on it, your stop loss may be wide. That's depending on what kind of a trader you are, and how many pips on the average you like to stake as stop loss. For example, in this case, that would be around 18 pips for stop loss. So when the candle that breaks, by the time it breaks the neckline and the candle that breaks the neckline closes, and you think is for the break, the area it closed is too far for you to enter, what you can do then is to wait for it to retrace. Sometimes it doesn't retrace, it keeps going, but no problem if you miss it. So in this case, usually the area of break of neckline is usually a place to put a pending order. Another way is that you can use the Fibonacci and look to enter at anything 50% or higher. I mean 50% of the Fibonacci or higher. When I say higher, I mean like 60% of it, 70% of it, 80 or 90. For example, this one here came up to 70% of the Fibonacci here. So, but anywhere, anytime you think it's wide, if you enter from where the candle that broke the neckline closed, you can go to the area where the neckline was broken and put a pending order there. You can also use the Fibonacci and put a pending orders from 50%, 60%, 70, 80, and sometimes 90. It all depends on what you think the market should do, and also the kind of structure, the entry structure or pattern you see there. Yeah. Moving forward. For example, here is a sell pattern. So this is the neckline here. And this is the candle that broke the neckline. This is the candle that broke the neckline. It closed bearish, but with a wick. So if it closes bearish and with a wick, that's fine as long as it closes bearish. So in that case, your entry would have been here, just here. That would have been your entry here. And your stop loss above here could be anything around, usually 5 pips above the high of that structure or that pattern or that entry pattern. Anything after 5 pips above it is high. This is not in addition to your spread. If the spread is too high, depending on the broker you use and the pair you use, but for pairs like GU, the USD pairs are usually generally 5 pairs above here, you're good. It will be good. For example, this is a 1.2153, 1.2158 is fine for this. So look at this, another entry pattern here. And this is the neckline area for this would be here. This is the candle that broke the neckline. So what you do in this instance is you can put a pending order here, a buy limit here. You can as well use the Fibonacci and put your pending orders anywhere from 50%, 60. You can spread it 50%, 60, 70, 80, depending on how many positions you want to enter. Sometimes it could activate maybe your first, second, and third and not activate others, and that's fine. So let's look for another pattern here. Here is another entry pattern. This here, the green rectangular area, is the neckline, and the candle that broke the neckline is this one. So when it breaks, you check if it's too far from you to enter. If it is, so what you can do is to put your pending orders here. So, but here is the thing. When you put your pending orders and the market, instead of going up to pick your pending order, it starts to dance around to accumulate. What you're going to do is to delete the pending orders, because if it accumulates here, it means it may gather liquidity enough to come and overrun this structure. So if you look at this structure here, this accumulation here, it did accumulate, gathered for buyers here, and then with this candle here, it went straight to hit the stop losses of those buyers with this candle here, this bullish candle. Before it went up, it first went down to clear all these liquidities here. It went down to clear these liquidities here, and then when it went up, and if you didn't delete your sell limit pending order here, it activated it and went to hit your stop loss. So the reason you should have deleted it is because of this structure it formed here, instead of just going up to activate your pending order. So when it starts to do this, you are better deleting your pending orders, because it's more likely it will go up more to ransack above there for liquidities. So here is another one. This is the neckline here. And this is the candle that broke the neckline. So one can enter here where it closed, or put a pending order somewhere here where the region it broke the neckline. Another area one might have put a pending order again is this zone here, which seemed like a place it could retrace to if it wants, although it didn't get there. And then your stop loss will be somewhere 5 pips below here. So look at this one here. Look at this structure here. Here is an entry pattern here, little one. And this is the candle that broke the neckline, this candle here. But like I told you, after breaking the neckline, the candle closed bearish. Once it has closed bearish, you should not enter. For a buy pattern, the candle that closes the neckline must close bullish. And because it didn't close bullish, it suggests that they are not yet done with the liquidity accumulation or hitting stop losses. And that's why you shouldn't have entered here. And so you leave it to finish with its work down here before entering. And when it finished, went down more, it then gave another, the main break of neckline, which is this. And because it's also far away, one may have used the Fibonacci here to enter somewhere here and that. So this may not really be a good buy pattern depending on where it formed them. This is in case this formed at a reversal zone where you're looking or waiting for the market to reverse. You should not have entered at this break of neckline here because the candle that broke the neckline closed bearish. So these are ways and nitty-gritties to spot reliable entry patterns. Another one is this one, formed an M here, an oblique M, and then closed, broke the neckline with this candle entry here, or use your Fibonacci, or place your pending orders somewhere here in this area, in this zone, but I didn't get there to activate them, and that's fine. Sometimes we miss them. No problem as long as you're safe. Another one is this one. This is the candle that broke the neckline, entry immediately, or you can open some positions and then put a pending order for other ones anywhere from here, and then it's activated it. Here is another one, a W. This is the candle that broke the neckline, entry, boom, up it went, stop loss somewhere here. This is another one here, and this is the candle here. This one here is the candle that broke the neckline, entry. And if you want, you can also put some pending order at this line, because that's another place it could likely retrace to before going down. You could as well use your Fibonacci. Yeah. So have a look at this one. Here is the neckline. This is the neckline here. And the candle that broke this neckline convincingly is this bullish candle. So because it closed bullish, you shouldn't enter. The candle that closes the sell entry pattern must close bearish. And the candle that breaks the sell entry pattern must close bearish, and the candle that closes a buy entry pattern must close bullish. If they do not, then they are not yet safe for entry or ideal for entry. This is another one here, and this is the candle that breaks the neckline. Then your entry, or use the Fibonacci to wait for around 50% retracement or more. And in this case, it didn't get up to 50%. So another way of entry is also placing your pending order at the break of neckline zone, which is here, and it did activate and up it went. So this is it, guys. In terms of entry pattern, remember entry pattern is this entry pattern is supposed to be used in conjunction with using your other parameters to frame your trade, starting from your directional bias and directional time frames. If you have any questions or something you would want me to do a video on, drop me a comment on the comment section, and please subscribe to the channel. Thank you very much, and bye.